So, what happens if the stock market crashes or there's a correction? So, you may be thinking, okay, you're saying there's these guaranteed rates in these insurance company policies, but what happens if the economy crashes? Won't all businesses be affected? Well, the short answer is no. Insurance, in terms of the whole life policies that we work with mutual insurance companies, are what's called a non correlated asset. It's a fancy way of saying they are not linked to any kind of stock index or any index of any kind. So the idea behind them is they make very strategic investments, which you can see in some other videos about where they're going to put their cash. So it's mainly in high-end real estate and businesses, things that are very cash flow positive and have long-standing results of making huge returns. And they have very, very large reserves as well, these insurance companies. So if the market collapses in any way, the stock market pulls back, there's a housing issue, whatever ends up happening as things make an adjustment in the market, the insurance companies, by and large, are not affected. You're still going to get that guaranteed floor of 4%. The only thing that might be adjusted is that dividend rate, because remember, what we're actually being paid on in terms of dividends and interest is actually the performance of the insurance company. So they are paying us a dividend and interest based on their year, right? So after they pay out their death benefits, their expenses, everything else, whatever leftover kind of overcharges in terms of what they charge their customers comes back to us in the form of those dividends and interest. So it's important to make sure that you understand they cannot have that much cash in the stock market. And that is because they're non-correlated. They're trying to make sure that they have an offset there. So their number one priority is returning a percentage of interest and dividends back to you as the policyholder. So if you look back over the last couple of economic crashes, right, the 1920s when you had the Great Depression, worst economy in hundreds and hundreds of years, you'll notice that at the cash value life insurance actually had consistent growth through that time. The only thing that was affected is there was less of a dividend and interest paid to their companies. So they still hit the floor, but the over and beyond what that floor was. So 4% was guaranteed and 6% was expected. They may have just paid the guarantee during that time. So there was still a pullback, but it was only on the portion that was not guaranteed. And you can see the same as you look through different crises. As the Korean War happened, then the 1980s savings and loan, and then the 2001 dot-com burst, and then the '08 market crash, the 2020 pandemic, you'll see a theme where these insurance companies sort of slowly just grinded forward, even though the economy was going all over the place, because they're non-correlated and their performance is based on things outside of the stock market. So that's how they're able to get those consistent returns. It's not going to affect you. That's why a lot of people like to diversify and have their safe, smart money deposited and warehoused inside of their policies, because they know that it's safe and it's guaranteed and it's growing, but it's still liquid. So in other words, they can participate in markets when things are good, and they can get out of markets when things are bad. And their smart money, their warehoused wealth is saved in these policies because it's not connected to any sort of stock exchange.